We go to chapter 3 of accounting A level. We have merger or purchase of limited companies. Introduction. Limited companies will often take over the company, other companies to achieve growth. That means we can achieve growth. Limited companies can achieve growth by taking over a new company. So there are many reasons why a company will merge or acquire another company, including one, to benefit from horizontal or vertical integration if the two companies are in the same line of business. Basically, one of the benefits of merger or purchase or merger is that it allows a company, the company that is merging or the company that is acquiring, to enjoy horizontal integration, the benefits of horizontal integration, which is integration that occurs when both businesses are in the same line of production. So they enjoy horizontal integration as a result of being able to produce more output and being able to sell to large numbers of customers. And for vertical integration, here it means that the business is either backward vertical or forward vertical, which means if it is backward vertical, it means the business is able to get resources from source for its supplies or for its production. And if it is forward vertical, it means the business is able to, to get more customers or more supplies for its customers. That is horizontal and vertical integration benefits. So to benefit from economies of scale, another reason why a business would want to merge or acquire each other is that they might enjoy economies of scale. How are they going to be able to enjoy economies of scale? They'll be able to enjoy economies of scale because they will be operating on a larger scale. And operating on a larger scale will definitely reduce the cost of production, the average cost of production. That's another benefit of merger or purchase. The third point is to secure a large market share and target new market segments. As soon as the business become bigger or expanded, it means it will produce more output in the market, and as a result, might be able to have more customers buying its own brand. And when company A and company B sells the same products in the market, it increases the customer base of company A and B together. And also, they might be able to target different customers based on their characteristics. That is for market segment. The fourth benefit of merger or purchase is that it reduces the level of competition in the market, which might allow prices to be increased. Here, we're talking about merger. If merger occurs in the market, or if merger occurs in the industry, if we have, for example, we have 5 companies in that industry, and if the first and second company merges together, that means the number of companies reduces to 4. As a result of that, the numbers of the choices that customers would make would reduce to 4, and that might increase the price of the products. So that's another benefit of merger. But it doesn't mean that merger or purchase does not have its own setbacks or risk. One of the risks that might involve is dilution of ownership and control, because 2 companies are coming together with different ownership. Now they have to come together with different ownership ideas, ownership style. They might have conflicts as a result of that. 2, dividends per share might decrease as there will be more shareholders. As soon as company A and company B merges, it means or takeover. Let's talk about takeover here. So if company A takes over company B, it means company A buys or purchases company B. It means more shareholders go into those companies, and as a result of that, dividends has to be paid to different shareholders. That reduces the dividends, which is a problem because shareholders will not be happy when their dividend is reduced. The third point, there might be a clash of cultures between the 2 companies. So company A and company B, they have different employees. As a result, there are different ways of life, different ways of working, different working procedure for company A and different working procedure for company B. Now they have to come together to work as one. It might be so difficult to do. The fourth point here, the larger company resulting from the merger or purchase might result in diseconomies of scale, such as poor communication, poor coordination, and lack of motivation. Merger or acquisition might bring about diseconomies of scale, which means the company might be too large to be controlled, might be too large to have a positive or efficient communication, and they might be running at a cost. They might have managers that become redundant as a result of merging because they have less to do. So these are the reasons why sometimes merger or acquisition is a problem. And the last point is the cost of goodwill that might be very high, especially if the business being purchased is not very profitable. Most of the time, buyers of company, they overprice the company based on the reputation the company has. Yes, the company might have a good reputation in the market, might have a good reputation, but the company might not be profitable presently. So if the company is not profitable at the present time, and the buying company buys it without being profitable, that means there will be high cost of goodwill as a result of that, which is not good for the company. That means they have overpriced the purchasing company. So that's about that. They'll go to what merger is itself. Merger is, they say merger. This takes place when two or more companies combine to form a single new company, which means company A and company B coming together to become company A and B, or to find a new name. That is merger. Therefore, purchase means a company A buys over company B in terms of its assets and take over its liabilities to become company A. That is what the purchase or takeover is about. Now, we go to the calculation of the purchase price. So to calculate the purchase price, we can use one approach, which is the net assets approach. So how do we use the net assets approach? For net assets approach, it is our current assets plus our current assets plus non-current assets minus cash and cash equivalents minus our current liabilities. That is how we get it. So I'm going to say that again. To use net assets approach, for net assets approach, we can use it to get our purchase price. And to use it to get our purchase price, it means we're going to add our non-current assets with our current assets, with less our cash and cash equivalents, and with less our current liabilities. That will give us our purchase price. According to what we have, the example we have here, we have the assets of a company, non-current assets, the current assets, the total asset gives us that. Then we have the equity of the company, which is 24.5 million. Now they said we should calculate the purchase price for the company based on the fact that we have 2.5 million cash and cash equivalents and the liabilities. So our total assets supposed to be 24.5, but we have to less 2.5 from it. So they did it here. So the non-current asset is 18, then the current asset is 6.5. We have to less cash and cash equivalents, then it gives us 22. Then our current liabilities will be less from it, which is current liability, which is 2.5. That gives us our net asset. So our net asset is the same as our purchase price. So that is how we calculate the purchase price using the net assets approach. Thank you.